Welcome back after the break. Let's shift focus to markets and Nifty is trying to touch 100 points mark in an attempt of touching 25,000 once again after it has already hit 25,000 mark in Monday's trade. But to discuss market and what is the long-term view, I have with me Alok Agarwal, Head Quant and Fund Manager, Alchemy Capital Management. Mr. Agarwal, welcome. I want to understand from you now, things seems favorable. Prime Minister has given GST Bonanza from Independence Day speech. Market has taken from both the hands. We have touched 25,000 mark. Do you think we are entering into a phase where select high growth counters will do well?
Yeah, hi, good afternoon. Certainly, that's a welcome news that we had over the weekend that the GST rate rationalization was announced, and that was quite a much needed kind of a support to stimulate the economy. We had seen over the last several months, especially RBI took a lot of steps on the monetary side. Earlier, the government had taken steps through some kind of direct tax adjustments and making a lot of regulations easier as well. But what was required was the stimulus on the fiscal side to ensure that the whole stimulation of consumption happens at the broader level. And this suggestion that has been given by the government to the group of ministers to rationalize the GST rates would go a long way in ensuring that the consumption stocks and consumption companies and sectors, they start doing well.
All right. Alok, also since we're talking about a very strong structural growth story, I really want to understand now what's the way ahead for you in terms of sectors where you were undervalued and now you really want to raise up the bar, and sectors where you are looking at good valuations and time for a longer structural story to have in the portfolio as well.
So let's put this way, there are certain sectors that have been slowing down and are still not showing too much of signs of growth. Those remain underweight, the likes of IT, the FMCG, to an extent oil and gas as well. But the sector that is the most structural sector in India has typically been the consumer discretionary. In the short term, it was showing some kind of a slowdown. And now with this GST rate rationalization, that should start showing a pickup. A lot of newer sectors which were like not really part of the frontline indices, they have been doing pretty well. The likes of electronic manufacturing, the likes of hospitals, reality, the consumer durables. So a lot of those segments have started coming back very well. And we are quite overweight on those segments that are growing at a faster pace and are having a great visibility of growth as well. Having said that, a lot of technology-oriented platform companies have started coming in, be it on the fintech space, be it on the insurance space, be it on the consumption or food delivery. So a lot of those companies, segments, which may not be really part of the frontline indices, but they are really growing at a good pace.
All right. What is your view on the financial sector per se? Do you think there will be an indirect benefit to even banks and NBFCs too?
I think the whole market has been waiting for these segments to start growing. And what we have seen broadly has been that the credit growth and deposit growth hasn't really been picking up. They have been hovering somewhere around 10%, which is actually quite a suboptimal number to have. And given that the rate cycle in which we are, a lot of these banks may still have some more way of NIM pressure to be seen. But yes, with consumption growth likely to pick up, that is likely to have some positive impact on deposit and credit growth as well. So we do remain selectively positive on the lender side, but within the financial space, we are more positive on the capital marketplace. And there the whole value chain, right from the exchanges to the wealth managers, to the asset managers and to select brokers, they're all showing a very good growth and visibility of growth as well.
Alok, I also want to understand, how are you placed as far as mid-cap and small-cap and the broader market is concerned? What kind of narrative do you think is going on over here now? Do you think that these particular market caps are going to lead the rally, or you think it's the time where you should be banking more on large caps, since we've seen a change from capex to consumption and it's good to go with the leaders? What's your take?
That's a very interesting one. There are two types of narratives in the market. One says that, the large caps are at 21 times 1 year forward valuation compared to mid caps at 27 times. And hence large caps are cheaper. One should be in large caps. But when you look at the valuations in the context of growth, the growth numbers are much higher in the slightly broader markets on the mid cap space, due to which on a per percentage growth basis, as we call as PEG ratios, the valuations don't seem too high. So I think the better way, instead of segmenting the markets into the large, mid, and small cap basis, it would be to look at those sectors and segments which are growing better. And those sectors actually currently happen to be more on the mid cap space. We named a few of them: the consumer discretionary, chemicals, the agrochem as well, fertilizers, some real estate names, EMS companies, hotels, hospitals, exchanges, and the whole capital marketplace, as I mentioned. So a lot of these names actually happen to be in the mid cap space. The larger caps are dominated by sectors which are actually not growing at a great pace. So I think focusing on the growth and the segments and cohort of companies that are providing that growth would fetch us better results as compared to focusing too much on the market cap divide.
Right. One sector which has been in focus for past 2 days at least is auto sector, and that has got renewed interest ever since announcements on GST is made, and the expectation is that this sector is going to be a major beneficiary. What is your expectation? How should one navigate in auto sector?
That's perfectly true. Auto sector is the poster boy for consumer discretionary play in India. It is one of those rare sectors where predominantly almost the whole of market is in the formal zone. So there's no informal zone there. And bulk of the vehicles there were being at around 28% GST. If a lot of them come to around 18% or so, that would actually be quite a relief for the consumers. And the price elasticity in that segment is also pretty high. So that is expected to generate that kind of volume growth. And hence, that should be positive. We are positive both on the auto side as well as on the auto ancillary side, because once the volume growth picks up, the whole engine on the supply chain on the ancillary side also picks up. So we remain positive on that side of the auto segment.
And auto ancillaries, you're pretty positive and bullish out there. But then what about chemical and fertilizer? Now, considering chemical as a sector is also having a structural change in terms of new proposals and reforms, how are you placed in your portfolios?
So, barring those which could be directly impacted by some imposition of tariffs, other than that, a lot of these chemicals have started showing some decent growth numbers coming back. We have had a period where, after a very high pace of growth, a lot of these companies went into capex, and hence the consolidation of earnings was underway for the last few years. But now, if we look at the last few quarters as well, the chemicals as a pack, they have started showing, a number of them have started showing good double-digit growth as well. So selectively, those segments where the visibility is high, especially on some of these specialty chemicals names, we are quite positive there.
All right, Mr. Agarwal, thank you so much.